Hey everybody, this is Eric Burkholder and I'm here with Jordan Bradford. And we just want to give you all a market update, kind of what's happening so far this year in 2022. It's been kind of a wild year in the market, which seems like most years are. That's just kind of the program. But we definitely want to give you kind of some thoughts and insights to what we're seeing. I can get us started.
Kick us off with, I guess, kind of a recap of the first quarter and kind of year-to-date numbers. Let us know where things are at in the market.
Yeah, so kind of two stories so far to the year, similar market performance, but early on we saw a big reversal from all the growth stocks that did so well coming out of the pandemic. Second half of 2020 and 2021 just were on an incredible run, many going up just at remarkable rates. We saw a lot of those come crashing down pretty hard. ARK Fund is a very popular one that Kathy Wood, the manager there, had become pretty famous during the COVID era. A lot of growthy tech stocks. And her fund, I think it's 60% off of its peak as of, I think, yesterday. So we just saw this kind of reversal, and growth really got hurt, and value held up extremely well. We actually saw value stocks positive for a large portion of the year, some still positive now. And then additionally, international stocks were outperforming, slightly negative to flat, and so significantly outperforming the U.S. So that was kind of the, mid-February is what we saw. The next kind of, or I guess the more recent development was the war in Ukraine. So when that started, we did see a little bit more of a sell-off of everything, and then we saw international get hit a little harder.
Right.
There's just more uncertainty over there. Both, developed international and emerging markets saw a sell-off. So, and then we had a little bit of a recovery. And then now, just since the end of the first quarter, we've seen kind of another hit the past, a couple weeks. And we've seen stocks kind of move off that recovery a little bit again.
Yeah. I think a good reminder that, the market's still pretty volatile and still pricing in all of the uncertainty with what's going on overseas and inflation.
Yeah, it's a lot of, there's always uncertainty, but right now there is, I guess, more, and also with the fixed income market as well. We talk a lot about the equity markets, but we have this very kind of rare situation where even though equity markets and fixed income markets were down, we actually saw the more aggressive portfolios outperforming the portfolios that were typically more conservative with more fixed income. That does not happen often, but a big reason is because inflation and inflation's been running very high. It was supposed to be short-term transitory was the word we saw. Doesn't seem like that's going to be the case now, and so when you have high inflation and just anticipation of interest rates going up, that's really going to hit fixed income pretty hard. So it's probably one of the most significant pullbacks in fixed income, certainly since I've been in the industry. Fixed income still has a place in the portfolio. At the end of the day, it still is less volatile and safer than equities. But as we're seeing, and when we talk about long-term and what makes the most sense and what protects your portfolio, it is a balance, and fixed income is just going to have a hard time keeping up with inflation going forward.
Right, and I think there's risk still with fixed income, and I think that we're seeing that firsthand in the first 3.5 months of the year. Is that despite the fact that I think fixed income has been relatively stagnant and low interest rate paying for many years now, we're kind of getting that all kind of rushing in at once, and we're seeing that movement in fixed income that's a little unusual, as you mentioned, right? I mean, typically more conservative portfolios performing worse than what is typically a more aggressive portfolio is a little kind of out of whack. But eventually, long term, we'll expect that things will again straighten out, and your more conservative portfolios will perform more conservatively, and so on and so forth.
Right, exactly. And to put it in context a little bit, you have some, depending what type of fixed income or bond you're looking at. I mean, they're down, let's say on average 6%. Some are worse than that, some are less, but that's a pretty large downward movement in fixed income.
Right.
Probably as big as we're going to see for a long time. And so that's nothing compared to a 30% drawdown, which is what we can see in the stock market. So again, it doesn't feel great, but you can see they're still more conservative. And then the flip side, I guess the silver lining is now going forward, those positions are going to be priced to yield more. And just like equity markets, the fixed income markets have anticipated those future potential interest rate rises. So,
right.
Even if we continue to get, the Fed continues to increase rates throughout the year, a lot of that has been priced in. And so if you have fixed income in your portfolio, you'll see that yield start to go up. And so that is a good thing for stability of income in your portfolio, but it's certainly going to be a headwind to your portfolio right now.
Yeah. Yeah, I think it just is a great example of why diversifying your portfolio is so important. In a time like where we're at now, when there is a disparity in fixed income performance versus equities in a way that is unusual, it's a good reminder that we need to be diversified across all asset classes, as well as many other factors that are influencing our portfolio performances.
Right, exactly. Yeah, and kind of on a related topic, and Jordan, I'll let you jump in on this one. The big question is, okay, inflation's high. What do I do? Do I put all my money in gold? I mean, what am I supposed to do at this point?
Yeah. I mean, obviously, we're seeing inflation numbers that we haven't really seen in, almost 40 years or so. So, for many people, they haven't seen this type of inflation in so long that it's not something we're accustomed to dealing with in our portfolios, or accustomed to having to hedge that risk. And, I think if we look at how inflation has grown over the last year, really what we're seeing is the biggest drivers of that has been energy and food. And a lot of that has really spiked since the start of the year, of course, with the war in Ukraine. That's obviously put a lot of pressure on energy prices, right? We're seeing that at the gas pump. Right. And I think that, we're also seeing that across the board with energy. Yeah. Same thing with food, right? Ukraine's a huge producer of wheat. And they export a lot of that, so that's having a larger than normal impact on food prices. And those two particular aspects of inflation are really kind of bumping the inflation numbers up a little higher than if they would be if you excluded them.
Right.
So inflation from March of this year, looking backwards 12 months, is about 8.5%. But if you exclude energy and food, it's around 6.5%. Yeah. So that's a pretty big chunk of inflation just being driven by what's really been happening in the last 3 or 4 months.
Right. So inflation's still high, but maybe if we read between the lines, maybe there's a silver lining there. Some things that are really out of whack are driving it to be even higher than it would be normally. Right.
And if we look at that core CPI, so excluding energy and food, the month-over-month inflation numbers are starting to lessen a little. So we're still seeing inflation. It still is here. And I'm not going to get into trying to predict where inflation is going to go, but in the month of March, it was a lower month-over-month number than it was in February and in January. So, that's a good sign, at least, that maybe we're...
Yeah, we got to start somewhere.
Yeah.
And the first step is I guess a decreasing increase, if that makes sense. It's still going up at a slower rate, and then we hope that will turn the other way eventually.
Yeah, exactly. And I think that as clients and investors, as we look at ways to protect our portfolio from inflation risk, I think the greatest example of that is what's happened with energy and consumer staples. So year to date, the market's been down, but energy has been way up. So energy stocks and utilities have been up, as well as consumer staples, which is going to encompass a lot of the food companies, right?
Yeah.
So historically, we've always known that inflation, or the best protector against inflation or hedge against inflation, has typically been the stock market.
Right.
And I think we're seeing that this year, even though the overall market is down, the areas where inflation is impacting the most, those sectors of the market are actually up and positive for the year.
Yeah.
So I think you can extrapolate that out looking forward as a way to potentially mitigate some of that inflationary risk and continue to diversify portfolios.
Right. Yeah. I mean, that's certainly the type of portfolios we build here because we're never going to take a bet on something. I mean, sure, you could throw your money at Bitcoin. Maybe it ends up being an inflation hedge. So far, it hasn't been. Gold is the one we always bring. I mean, so instead of trying to bet on one asset class that may or may not pay off big with inflation, we're going to take a more diversified approach because we know historically sectors like you mentioned tend to do well when we have high inflation. And the stock market in general tends to keep up with inflation. Companies have pricing power. They raise prices as inflation goes up, and it's really a good time to be diversified. We went through a kind of this period of the market where just owning large growth U.S. stocks, that's all you needed to own. They went up all the time, and so now it's finally paying off. A lot of the sectors you mentioned are traditional value companies, and that's why we're seeing, even internationally, where there's wars going on, value is positive, I think, year to date, international value. And in certain sectors of value are positive in the U.S. as well. So that is why we build portfolios with different things that behave in different types of markets.
Yeah. I think being disciplined is the key takeaway. I think from that is,
right.
Don't look at what's happening in the market and try to chase a return here or there, but just have a disciplined strategy and know that eventually it's going to pay off. And if you've been disciplined for the last 5 years, that's paying off for you this year.
Yeah.
And you may have thought the last few years, should I go more aggressive on the growth side? But we're seeing that things tend to even out. Averages are averages, right?
Yeah.